The last time the housing market ignored warning signs, it didn't end quietly. Prices collapsed, equity vanished, and millions were caught off guard. Today, those signals are flashing again, and most buyers aren't paying attention. In this video, 10 U.S. states where home prices could crash low to 2008 levels, housing market warning. We're cutting through the noise to break down the hard data behind today's real estate market. This isn't fear bait. It's market analysis grounded in affordability metrics, price momentum, migration shifts, insurance costs, and recession-level pressure building beneath the surface. You'll see how the same conditions that fueled the 2008 financial crisis are quietly re-emerging, and why certain states are showing stress fractures before the rest of the market even reacts. If you're a homebuyer, investor, or just trying to understand where property values and housing affordability are really headed, this breakdown will help you think strategically instead of emotionally. Watch until the end, because missing these signals could be expensive. And if you value fact-driven real estate insights, hit that like button, subscribe to the Globe Realty, and join the conversation below. Number 10. North Carolina. Let's be honest. Putting North Carolina at number 10 on a list of states most likely to see home prices retreat toward 2008-style lows might feel a little controversial. After all, Raleigh and the Triangle have been poster children for strong home price growth and tech-driven demand for years. But when we look closely at current data, there are clear cracks in the foundation that buyers and investors must understand before assuming prices are bulletproof. First, take a look at what recent valuations show. According to Zillow data, the average Raleigh home value, once rising rapidly, has actually declined about 2.8% year over year. A subtle but important signal that price momentum is turning from acceleration to stagnation or contraction. Meanwhile, statewide data from Redfin confirms that even though median home prices in North Carolina rose only about 1.7% in December 2025, the percentage of homes selling above list price has dropped, and properties with price drops are rising, much closer to a balanced or buyer-advantaged market than a frenzied seller's market. Now ask yourself this. If prices can barely edge forward in one of the Southeast's most dynamic markets, despite a strong local economy and rising population, what happens when mortgage rates tick higher again, or recession pressures intensify? That's exactly the kind of vulnerability we're warning about. Add to this an insurance cost shock. North Carolina homeowners face projected average insurance premium increases of about 15% by mid-2026, particularly along coastal counties, a dynamic that stokes affordability stress and could force price adjustments in more exposed areas. Some markets in the state still show modest growth, but that's a mixed signal, not stability. And while broader statewide metrics still lag a true crash, the trend lines, slowing growth, rising inventory, more homes selling below list, and affordability pressures, are unmistakable. If home prices can't sustain momentum in Raleigh and other Sunbelt hubs right now, serious declines become less improbable and more plausible if the next recession hits. Number 9. Colorado. Now this one might ruffle some feathers. Colorado isn't exactly your typical crash risk state in the way we think of Detroit in 2008. But when you dig into the data and peel back the headlines, you start seeing real strain beneath the surface, especially in Denver and Front Range markets that used to be unstoppable engines of price growth. Let's get into it. Metro Denver's median home price, once surging year after year, is now actually showing softening and stagnation. According to local reports, median single-family prices hovered around $575,000 to $630,000 in late 2025, with recent data even showing a slight year-over-year decline of about 0.5%, a rare shift from past growth trends. Here's the twist. On paper, prices might still look okay, but the underlying dynamics tell a different story. Inventory has ballooned, with active listings climbing sharply compared to the pandemic era, sometimes 40 to 50% higher than pre-COVID norms. That excess supply means more choice and more time on the market. Homes that used to sell in days are now lingering weeks or longer. And that's not psychology, that's math. As inventory rises and buyer demand softens, price growth slows first, then flips to flat, then to negative territory. We're seeing that too. Attached homes like condos are experiencing more pronounced price dips, with some segments down as much as 5 to 6% year over year. If Denver's housing market, one of the country's poster children for strong pandemic-era price growth, is hitting these pressure points now, what happens if mortgage rates tick up again or broader economic weakness hits? Buyers are gaining leverage, sellers are more flexible on price, and homes are taking longer to sell. Clear early warning indicators that supply is surpassing demand. That's the kind of sideways drift markets go through before steeper drops materialize. And unlike headline stats showing flat prices, these subtle shifts matter. Number 8. California. California showing up on this list will upset a lot of people, and that's exactly why it belongs here. Not because California is about to implode overnight, but because it's one of the clearest examples of a market where prices stop making mathematical sense, and the correction phase is already underway in slow motion. Let's start with the data. In several key markets, San Francisco, Sacramento, and Stockton, home prices are already down from their 2022 peaks. San Francisco remains one of the weakest large metros in the country, still sitting roughly 10 to 15% below peak values, depending on the neighborhood. Sacramento and Stockton, once magnets for Bay Area refugees, have seen year-over-year price declines or flat growth, even as borrowing costs remain high and buyer demand cools. Here's the uncomfortable truth. California didn't just have a housing boom, it had an affordability breakdown. Today, the median home price statewide still hovers around $750,000, while mortgage rates have more than doubled from pandemic lows. That combination has pushed California's homeownership affordability index near historic lows, meaning fewer and fewer residents can actually qualify to buy. And then there's outmigration. California continues to lose tens of thousands of residents annually to states like Texas, Arizona, and Nevada. This isn't just a political talking point, it directly affects housing demand. When population growth slows or turns negative, prices lose their biggest long-term support. Now let's talk costs beyond the mortgage, because this is where California quietly starts to resemble pre-2008 stress. Insurance premiums are exploding, carriers are pulling out of wildfire-exposed regions, and property taxes plus utility costs keep climbing. Even high-income households are starting to ask, why am I paying this much to stay? Inventory is another warning sign. In many California metros, active listings are rising faster than sales, especially for higher-priced homes. Properties are sitting longer, sellers are cutting prices, and concessions are becoming normal again. Something we didn't see during the boom years. So no, California may not crash like a rural boomtown. But that's not the point. Big, expensive markets don't collapse quickly. They deflate slowly, grinding lower as affordability, migration, and demand stay under pressure. Here's the real question for you. If prices already fell with a strong labor market, what happens if a real recession hits? Number 7. Florida. For years, Florida was marketed as crash-proof. Sunshine, migration, remote work, retirees, cash buyers. The story sounded perfect. But when you strip away the hype and look at the numbers, Florida is one of the clearest examples of a market where the math has flipped. Several Florida metros, Cape Coral, Northport, Deltona, and Tampa, are no longer just cooling. They're declining. Cape Coral stands out in particular, with recent data showing year-over-year price drops approaching 10%. Placing it among the steepest declines in the entire country. That's not noise, that's momentum breaking. So what changed? First, supply. Florida massively overbuilt during the pandemic boom. Builders chased migration trends that are now slowing, and inventory has surged. In many Florida metros, active listings are up 40 to 60% compared to 2021 levels, while demand has cooled sharply due to higher mortgage rates. Homes that once sold in days are now sitting for months. Second, and this is the Florida-specific problem most buyers underestimated, insurance. Homeowners' insurance premiums in parts of Florida have doubled or tripled in just a few years. Some buyers can't even close because insurers won't write new policies in coastal or flood-prone zones. Others are walking away after realizing their monthly housing cost doesn't stop at the mortgage. This single factor is quietly destroying affordability. Now layer on property taxes, HOA fees, and special assessments, especially in condo-heavy markets like Tampa and South Florida. Suddenly, that affordable Florida home costs more per month than comparable properties in states with higher sticker prices but lower carrying costs. And here's the uncomfortable question nobody wants to ask. If Florida prices are already falling without a recession, what happens when job growth slows or unemployment rises? Migration hasn't stopped, but it has normalized. And normalized demand can't support pandemic-level prices, especially in markets that ran up 50 to 70% in just a few years. If you bought near the peak, are you prepared to ride this out? Or are we watching Florida's boom quietly turn into a long, grinding reset? Number 6. Arkansas. Alright, when most people think of housing crash risk, Arkansas probably isn't the first state that comes to mind. The truth is in the regional divergence, and the data reveals something ugly hiding beneath a calm surface. Let's start with the elephant in the room. Statewide, Arkansas still shows positive median price growth, around 5.7% year over year, with a median sale price near $270,000 as of late 2025. That sounds fine, until you realize that price growth is uneven and unstable. Markets like Northwest Arkansas, Fayetteville, Springdale, Bentonville are holding up well thanks to corporate job engines like Walmart and Tyson. But in other pockets, most notably Helena and Helena West, prices are collapsing. Take a look at the Redfin data for Helena West Helena. Some reports show median sale prices down as much as 86% year over year, with homes listing at pennies on the dollar compared to a year ago. That's not correction. That's market failure in microcosm, an extreme indicator of localized distress that would have been unthinkable in most markets just a decade ago. Now ask yourself this. If Helena, a smaller Arkansas market, can experience that level of collapse, what does that signal for the broader state if economic headwinds worsen? Especially when realtor and forecast models already see other smaller Arkansas areas, Forest City, Magnolia, projected to decline by up to 6 to 10%. Yes, Arkansas overall is more affordable than the national average, with typical home values well below most U.S. metros, and that historically attracts buyers. Affordability is its strength and its weakness. When mortgage rates climbed, lower-cost markets initially held up because buyers could afford entry. But as demand stalls and inventory builds, price pressure flips quickly, and regions with limited economic diversification get hit first. Here's the controversial part. Arkansas isn't on this list because it's doomed statewide. It's here because extreme local variability is a smoke signal. When a state has markets appreciating and markets collapsing concurrently, it highlights fragility. That's the same pattern we saw before 2008, where averages obscured deep weakness underneath. If you are finding this video eye-opening, do me a favor and hit that like button, subscribe to the Globe Realty, and turn on the bell. It will help us reach out to more people who equip themselves with data-driven insights on real estate before investing. And now, the top 5 on this countdown. Number 5. New Mexico. Now here's a state that most viewers are not expecting on this countdown, yet New Mexico lands squarely in the middle of this list. But don't brush this off just because it's not a coastal powerhouse or a major tech hub. In fact, that's exactly why New Mexico is dangerous territory right now. Let's start with the hard numbers. Markets like Hobbs, Clovis, and Roswell are showing year-over-year price declines approaching -8% to -10%. Those aren't minor blips. They're statistically significant downturns in places where housing demand used to be stable. According to recent Redfin data, the median sales price in Hobbs dipped almost 9.8% from a year ago, while inventory levels have grown faster than buyer traffic. That's textbook early correction behavior. One factor driving these drops is the local economy's heavy reliance on cyclical industries like oil and gas. When energy prices weaken or production slows, jobs disappear, wages drop, and suddenly buyers become holdouts instead of bidders. Hobbs, for example, is tied closely to the Permian Basin oil economy. When oil demand softens, housing demand follows. The ripple effect? Bigger price swings than you'd see in more diversified states. But let's be real here. There's another uncomfortable truth staring us in the face. While New Mexico overall may not have the explosive, post-pandemic price run-ups seen in states like Florida or Colorado, Its slower growth markets lack the buffers that protect against downturns. When the market cools here, it cools hard, because there's less economic insulation and fewer jobs to buoy consumer confidence. Here's a question for you. If prices in a smaller market like Hobbs can fall nearly 10% without even a full recession, what happens when bigger macroeconomic stress hits? Unemployment rises, lending tightens, or consumer sentiment falters. Now, contrast that with bigger metros. Sure, Albuquerque and Santa Fe haven't crashed spectacularly, but their growth is stalling, especially among first-time buyers who are priced out by high borrowing costs. With affordability already stretched thin, even a minor economic shock could push these markets into deeper territory. Tell me in the comments, would you invest in a market like Hobbs right now, or does this data make you think twice? Number 4. South Carolina. South Carolina's placement at number 4 on our countdown might surprise some of you. After all, this state has been the go-to narrative for steady growth and booming relocation demand for years. But scratch the surface and you start seeing that why South Carolina is on this list isn't because it's collapsing everywhere, it's because it's splintering. And in housing markets, divergence often comes before big corrections. First, let's talk data that can't be ignored. According to Zillow's latest Housing Values Index, the average home value in South Carolina has slipped about 0.4% year over year, with total statewide values nearing just under $300,000, essentially flat after years of rapid appreciation. That's not growth, it's a plateau with downside risk. But that statewide average hides a deeper story. Price reductions and declines are rising sharply. Realtor.com and market reports show that roughly 21% of homes statewide experienced price cuts in early 2025, one of the highest percentages in the nation. That's a textbook shift from a seller's market to a buyer's leverage environment. Now, here's where it gets controversial. Smaller towns like Bennettsville aren't just softening, they're showing substantial declines. Zillow's data indicates typical home values in Bennettsville have dropped by double-digit percentages, sometimes approaching or exceeding -13% year over year, depending on the index and timing. That's not normal seasonal fluctuation, that's structural weakness. Contrast that with metros like Charleston or Greenville, where prices may still show modest gains, and you start to see polarization, a hallmark of markets before broader adjustments. Some buyers here are winning again, but others are losing pricing power. Think about that. You can buy in one part of South Carolina for less than last year, while another nearby city still holds value. That's unusual in a healthy market. And with home sales in SC roughly flat, not climbing, despite population growth and net migration, there's a growing disconnect between demand narratives and real transaction data. Here's a question for you. If price cuts are rising and average values are flat, while inventory quietly builds, what happens when mortgage rates rise again or economic confidence weakens? Number 3. Louisiana. Now this is where the narrative gets real. Louisiana might not look like an obvious candidate for housing stress when you glance at broad statewide averages, but when you drill into local markets like Opelousas, Houma, and Morgan City, the data tells a very different story. One that mirrors early pre-2008 fracture patterns. Let's start with Opelousas, a smaller Louisiana market that's already in correction territory. According to the most recent Redfin data, the median home price in Opelousas has dropped nearly 15% year over year, with homes lingering longer on the market and weak buyer demand dominating the scene. That's not just a slowdown. That's a meaningful price contraction you rarely see outside broad recessions. But it gets more dramatic in Houma. Redfin's local figures show median sale prices down about 24% compared to last year, with properties now taking significantly longer to sell. A classic sign demand has evaporated and sellers have lost leverage. Zillow's own index also shows nearly a 9% year-over-year home value decline in the Houma area, emphasizing that this isn't one isolated data point, but a trend across multiple reporting models. So what's driving this? Let's get into the uncomfortable economics. Louisiana's housing challenges are deeply tied to regional economic stressors, including reliance on energy and petrochemical sectors that are volatile and sensitive to broader economic cycles. Put simply, when jobs weaken or capital inflows dry up, smaller markets with less diversified economies feel it first. Then there's the elephant in the room: insurance and climate risk. Louisiana homeowners face some of the highest property insurance costs in the U.S., driven by hurricane, flood, and storm exposure far above the national average. These aren't trivial increases. Some estimates show premiums jumping more than 25% in 2025 alone, pushing total annual costs toward $14,000, a material hit to affordability. Here's the irony. High insurance costs, storm risk, and rising inventory don't just hurt buyers, they hurt sellers too. When owning becomes expensive and risky, demand dries up, price negotiations strengthen, and markets begin to look less like expansion and more like correction. That's exactly what we're watching unfold. So let me ask you this. If smaller Louisiana markets are already recording double-digit declines with only moderate economic headwinds, what happens when nationwide affordability cracks and recession pressures rise? Number 2. Texas. When you hear Texas housing market, most people think unbeatable growth, booming jobs, and never-ending migration. But if you dig into the actual pricing trends and forecast data, you realize that much of the Lone Star State is standing on a fault line of slowing demand, rising inventory, and regional overbuilding, the very conditions that preceded the 2008 crash. That's why Texas lands so high on this countdown. Let's talk specific markets that are dragging the state toward risk territory. According to Zillow-based projections, smaller Texas areas like Pecos, Alice, Zapata, Big Spring, and Raymondville are forecast to see home price declines around -8% to nearly -12% between late 2025 and late 2026. Pecos leads the group with a projected -11.8% drop, and Alice and Zapata aren't far behind. Now ask yourself this. These aren't big urban hubs. They're smaller regional economies often tied to oil, gas, and cyclical industries. When energy prices fluctuate or local employment softens, demand can fall fast. Unlike major metros with diversified economies, smaller Texas lack the safety nets that cushion housing downturns. Here's something many viewers won't expect. Even statewide data paints a sobering picture. The average Texas home value, according to Zillow's Home Value Index, sat at about $294,000, with a -2.4% year-over-year decline as of late 2025, and nearly 67% of sales occurred below list price. A clear shift toward buyer leverage. That's not small change. It signals a loss of seller power and a cooling market environment. Meanwhile, inventory has climbed across the state, rising close to its highest levels since 2016, and sales volumes have actually declined year over year in the first quarter of 2025. And here's where it gets controversial. Even some larger Texas cities aren't immune. Recent reports show Austin posted one of the fastest month-over-month price declines in the U.S., and San Antonio, Dallas, and Houston all exhibited downward pricing trends as well, signs that the correction isn't just rural. So, while Texas may still boast strong job growth and long-term appeal, the short-term housing data is sobering. If you were banking on perpetual price growth, this chapter in Texas real estate might be the wake-up call you didn't see coming. What do you think? Is Texas just correcting and rebalancing, or are these warning signs the start of something bigger? Drop your thoughts in the comments. Number 1, Mississippi. Mississippi takes the top spot on our countdown of states most at risk for home price drops, approaching 2008-style levels. And the data driving this is genuinely alarming. This isn't about a mild slowdown. We're talking double-digit projected declines that echo the worst of past housing busts. Let's start with Greenville, the most extreme case in the state. Zillow forecasts show home values there could fall by up to -18.4% by late 2026. That's one of the steepest projected declines in the entire country. Now that number might shock you, but when you dig deeper, it makes sense. Median home values in Greenville have already dropped over 20% in the past year, according to the latest Zillow Home Value Index. But Greenville isn't an isolated outlier. Nearby Mississippi towns like Cleveland and Clarksdale are also facing serious downward pressure. Zillow's metro forecasts show Cleveland's home prices could be down around 10.4% and Clarksdale around -9.5% by mid-2026. Even Indianola and Meridian aren't immune, with their own projected declines in the -7% to -10% range. So what's happening here? A few key things. Local economic weakness. Many of these markets rely heavily on industries like agriculture, manufacturing, and small business sectors that aren't booming. Without strong job growth or new economic drivers, demand for housing dries up fast. Excess supply. Unlike booming markets in big Sunbelt cities, these Mississippi towns suddenly have more homes for sale than buyers willing or able to purchase them. A fundamental imbalance that pushes prices down. Here's the controversial part. This isn't just a Mississippi problem. It reveals something about smaller markets nationwide. When prices go up dramatically in small towns during boom years, it takes very little negative momentum to flip the market into steep decline, because there's no economic diversity to absorb shocks. This is exactly what we saw before 2008. And now, the same pattern is emerging, just in different states and under different conditions. Let me ask you, if the most affordable corners of the U.S. housing market are the first to crack like this, what does that tell you about the broader market? Are these early warnings we should have seen, or signs most buyers are ignoring until it's too late? Drop your thoughts below. And there you have it, the full countdown of the top 10 U.S. states where home prices could crash back to 2008 levels. From North Carolina's softening Sunbelt markets to Mississippi's smaller towns facing double-digit declines, the pattern is clear. Affordability pressure, rising inventory, and economic fragility are showing up first in markets most people aren't watching closely. This isn't fear-mongering. It's fact-driven analysis. The early warning signs are real, and understanding them could save buyers, investors, and homeowners a lot of money. Some markets may still hold value, but others are already on shaky ground, echoing the conditions that triggered the last major housing crash. So what's the takeaway? Watch the data, watch local conditions, and don't assume that just because prices are high or a state is popular, it's immune to correction. Ask yourself, where do I want to invest? Can I afford to wait? If you found this countdown insightful, make sure to hit that like button, subscribe to the Globe Realty, and turn on notifications so you never miss the latest housing market updates. And drop a comment below. We want to hear from you. Which state surprised you the most? Would you still buy there, or are you holding off? Stay smart, stay strategic, and always let the data guide your real estate moves.